Hey everyone, hope everyone's having a good Saturday. This is Travis back with Tax Talk with Travis. Today I'm going to go over a topic that's a little different. I'm going to go over a rental property that I'm in the process of purchasing and just kind of wanted to go over the spreadsheet that I use to analyze rental properties in 5 minutes or under. So as you can see on this Excel spreadsheet, I have a couple of things just to start with over here. So my minimum when I'm looking for a rental property, depending on how many doors it has, which means, if it's a duplex, it has two, fourplex, four, I want at least $150 of cash flow per door. I'm also looking at 6% cash on cash return, and then I want a 10% return that does not include appreciation. And so I can show you where those numbers come in a little bit. But this is a spreadsheet that I put together so that when I'm looking through the MLS that my realtor set up for me, that I can very quickly analyze whether a property is worth looking into or not. Just because the spreadsheet tells me, oh yes, the property looks good, doesn't mean it's necessarily a good buy. There's a lot of other factors that go into it, but this is kind of what I use to narrow down, okay, out of the 20 listings, these are the 4 that are worth looking into further, whereas the other ones just don't make sense. So this property in particular, it was listed at $349. My realtor happened to know that the sellers were on a hard money loan, meaning that they were sitting on about 10% interest. And so every month that they didn't sell the property, they were racking up big interest bills. And so they had actually just recently, they were flipping this property. So it was completely renovated inside and out, new roof, new water heaters, new countertops, everything. So the property is in really good condition for the area. And so my realtor recommended coming in at about $290, knowing that they were on the hard money loan and needed to get rid of this property. They countered back at, I think, $310, and then we ended up settling at $295. So as you can see, it's a pretty big discount off of the listing price, but I felt like we did pretty good on this. So I always do 25% down on my loans, and so the down payment right here just auto calculates 25% of the purchase price. I always do 30-year loans. On this one in particular, the difference between paying a point on the loan and not paying a point was a full percentage. So it's gonna be 4.875 without a point. It's 3.875 with a point. And so I decided, on this, since I'm planning on holding this property for 30 years, that, lowering the interest rate by 1% and paying the roughly $2,200 up front was going to be worth it. And so there I have the, 5,162 in closing costs, which includes that point. That number is a little lower than it normally would be. With the $295, we also got a seller credit, and so they paid for some of the closing costs. So really, in reality, the purchase price was about $292. And so here's kind of just how I automate looking at properties as quickly as possible. So you just plug in your monthly rent right here. Like I said, it's a duplex. So this is the 2 renters right here. That comes over to here when you look at it, annually, just the monthly rent times 12. Vacancy rate for the area that I look at is about 5%. And so that's why there's a negative number right here. So that's 5% of the rent. And then mortgage. So here's our mortgage payment, roughly $1,040. What you can do when you first have a property that you want to look at, you can just search an amortization calculator for a mortgage. There's plenty of calculators online, and what you can do is just put in your years, your percentage, and your amount, and what it'll do is it'll pop out your monthly payment. So that's where this 1,040 comes from. But the other thing that you can get from that is your yearly principal. And so when you make a mortgage payment, it's made up of principal and interest. The first year in particular, you're paying a lot of interest, and so your principal isn't very much. So like over the first year, I'm going to pay over $12,000 in payments, but only about $4,000 of it actually go into principal. So that number actually flows down to here. But yeah, when you take out our yearly mortgage and then our expected vacancy, and this number could be 0. So I use vacancy just because I like to be realistic. Tenants do move out, and you do have costs that pop up. So here's our gross profit. This property, if you look at the MLS and kind of what we've looked at for the property, our property tax is going to be about $1,200. We're going to pay about $900 in insurance. And then I have a property manager that runs the properties for me. And so we pay him 10% of the monthly rent. And so this number, takes into account, okay, here's the rent that we're expecting, also the vacancy. If it's a vacant and we're not collecting rent, we're not paying him 10% for that month. Maintenance. This is another number that's automated. And so what I do for maintenance is I take 1 month's rent and then I times that by 1.5 or 150%. And that's kind of what I account for my repair reserve. On this property in particular, with it being a new flip and everything's kind of new and it being a newer property, that number could be 0 for the year. It could be bigger, but I use that 150% just so we set aside money for, big repairs that could pop up. Who knows? The roofs are in good shape, but you never know what's going to happen. And roofs are not cheap. So if you don't account for any of that, a roof repair or a roof replacement could wipe out your cash flow for a couple of years if you're not putting money away. And then in this property, we will pay the water and sewer for the tenants, and so that comes out to about $125 a month. So that's where that $1,500 comes from. So if you look at that, I mean, we're netting on this property about $4,800 a year, and so that's where this monthly cash flow about $404 comes from. So my spreadsheet kind of just tells me, okay, am I meeting my 150 per door? So yeah, there's 2 doors on this. This is a duplex. Monthly cash flow is 404. So yes. Tax profit. This is a little different for everyone, and so the realtor or the investors that I invest with, kind of the average tax rate that I use is about 22%, and so you take your tax gain or loss, which is this 251 right here, and this includes a couple different numbers. So we're netting cash of about 4,800, but when you're doing the taxes for a rental property, you can't write off the payments that you made for principal, so that's where this 3982 comes in. And then there's also something called depreciation. So depreciation, you take percentage of your building. I usually take about 80% of my purchase price, and then you depreciate that over 27.5 years. That's not cash coming out of your pocket. That's just, the IRS saying, okay, hey, we understand every year the property has wear and tear. Here's your expense for that. So that's a non-cash expense, but that does lower our taxable income, which is great for rental property because, like I said, we're expecting to net about $4,800, but we're only going to pay on about $250. And so that's why you do have, a net negative right here. Monthly principal. And so this is this principal number right here divided by 12. So this is just, okay, the number that we expect, our principal to go down each month, and hopefully the tenants are paying it for us. Then right here, monthly appreciation. So what I do with appreciation, I try to be really conservative when I'm accounting for this. The market that I rent in has had appreciation rates of about 8%, which is really big year over year. I don't expect that to continue forever. So I actually just use 3%. And so if you take 3% of our loan divided by 12, that's kind of the rough monthly appreciation. And so this is the monthly kind of net worth increase that we're expecting. That's we're going to put some money down, but yeah, roughly $1,500 a month is pretty good. And so if you look over here, yearly return, take that times 12, 17 grand. Overall return, take all your costs you put in your yearly return. We're looking at roughly a 22% overall return, and then cash on cash return of about 6%. So we hit like I said earlier, we hit our criteria for the $150 per door over here. Did we hit our 6% cash on cash return? Yes. And then 10% with no appreciation. Appreciation is a fickle thing. You can't always depend on it. Something could pop up. Such as a sickness that swipes the nation and, could knock down real estate prices. So you don't always want to count on appreciation. And so what I do is I say, okay, if appreciation was 0, am I still making, a 10% net worth return? And so what I do on that one is I would take this yearly return, and then I would just take out this appreciation amount. And as long as I still hit a 10% return, the property is at least worth looking into. And so on this property, it happens to be a yes. But kind of the way that I've set up this spreadsheet is I can just change things very quickly. And so, for our monthly rent, it's at $2,390, but let's say that the rent was only $2,200. So you see that and you say, okay, that the rent dropping by $200 a month changes things dramatically. So our cash, our cash net return would only be, roughly $3,100 versus the $4,800 it is. And so that knocks me down from the 6% cash on cash return. That knocks me down where I'm not seeing $150 per door anymore. And then I'm also not seeing a 10% return with no appreciation. And so, like I said, that's why it's so important to include that vacancy amount in there. Because if you don't, and you have a tenant that moves out, 1 month with no rent could just completely wipe out your numbers for the entire year. And same with the repair numbers. If it's 150%, and like I said, this property is recently renovated, so I don't expect massive things to pop up. But I mean, say this number was 6,000. If that number pops up to 6,000, our cash on cash return goes way lower, and then all of a sudden this, we're not meeting our goals. And so that's why, when some people analyze rental properties, they say, oh, it's a brand new property, or oh, it's recently renovated, I don't need to account for repairs. You always have to account for what I consider not the worst case scenario, but you do need to be somewhat conservative when you're looking at rental properties. And so, yeah, this is the spreadsheet that I use when I look at every single property that comes across the MLS. And if it hits those, those three criteria, that's when I look into it more. And if we can get a good deal for it and it's, in a good enough area that I expect to see some appreciation, that's when we move on it. And so, yeah, we actually close on this one middle of next week. So this is another property that I'm really excited about owning and adding to our portfolio. Thanks for checking out this video. If this gave you any new info on rental properties, or if you just want a copy of this spreadsheet, let me know. If this was helpful, please like and subscribe, and I'll be putting out more videos on rental properties as well as different things going on in the world of tax and finance. Thanks. Have a good day.